Hello, and welcome to the Freddie Mac Connect Discover Opportunities with Mortgage Ready Borrowers session. Audience members are in listen only mode. This session is being recorded and will be available following the conference. To submit a question, please use the Q&A box at the bottom of your screen. If you experience any technical issues, please use the Q&A box and someone will assist you. Lastly, you will find icons at the bottom of your screen with links to the speaker bios and the presentation deck. With that, I will turn it over to discussion moderator, Vice President of Housing Insight and Solution, Cindy Waldron. Cindy, the floor is yours.
Thank you, Kiera, and thank you for having us today to talk about some of the research my team has done. First, let me introduce Larice Brown, who is a principal economist and senior director on my team, leading regulatory research for our affordable housing and duty to serve, and Jaya Day, who is also a director and principal economist on my team, who leads equity, sourcing, and market research. Today, we're going to talk about the power of insights. This means how we drive decisions by using data to be more deliberate and intentional. We're also going to talk about identifying future borrowers. We are using data on all credit visibles in the United States to better understand their barriers and opportunities to help create homeownership for future borrowers. We're going to talk about opportunities to get borrowers mortgage ready. What can we, as Freddie Mac, and you do to help move borrowers of the future to be more ready to be sustainable homeowners? We're going to talk about considerations for minority borrowers. Each segment of the population is unique. We will show some of our research by race to see some of the segments, how they differ, and share those insights with you. We're going to talk about resources to drive first-time homeownership. We are launching a new tool that is free and open to the industry to help you to better understand affordability geographically. And lastly, we will summarize highlights from our talk to drive action. So let's talk about the power of insights. Data and research can provide more intentional and deliberate actions that evolve into informed action from our clients, for our clients and partners. So, for example, we can better understand geographically the affordability challenges and opportunities so we know how to address them more surgically versus a big macro, more expensive approach. We also use our analytics to better drive our affordable goals and to help underserved markets. This is powerful as it allows us to achieve our mission of liquidity, stability, affordability, and equitable housing. We have unique data access such as the National Mortgage Database from FHFA, which is a random sample of mortgages in the United States. We also have credit bureau data that has all credit visibles in the United States, meaning they have one or more trade lines. That allows us to drill down geographically. We can go by age, race, and income, for example. Our approach to understanding the borrower of the future is to look at their whole ecosystem. We use data to see what their credit profile is, the housing stock where they live, how much they can afford based on the housing and interest rates, and how long it will take to save to buy a house based on the money needed at closing. We also continue to peel the onion to better understand the challenges they face so that we can have data-driven decisions. So let's go deeper into our approach. Jaya, can you better explain what we mean by mortgage ready and how we identify the borrower of the future?
Thank you, Cindy, and thanks for having me here. So at Freddie Mac, we use a unique approach to identify the future homeownership potential. We have unique credit bureau data that enables us to size the future homeownership potential by looking at the credit profile of the credit visible population. By looking at the credit profile and also by using simple underwriting standards, we define the borrowers of the future. Keep in mind, some of these underwriting standards that we use are not really underwriting criteria, they are solely research criteria. So here are some of the definitions, some of the categories that we put the future borrowers in. So first, let me start with mortgage ready. The mortgage ready are the population that don't have a mortgage currently, but have certain credit characteristics that could potentially qualify them for a mortgage in today's marketplace. So to become mortgage ready, what are some of the criteria that you have to meet? So you have to be 45 years or younger. Credit score should be above 661. No DTI, DTI should be less than 25%. No foreclosures or bankruptcies in last 7 years, and no severe delinquencies in last 12 months. Then we have the next category, which we call the near mortgage ready. These people basically mimic the mortgage ready population, except that their credit score is a little bit lower, between 600 and 661. So they are basically near to becoming or getting the credit characteristics that could potentially qualify them for a mortgage. And lastly, if you are not a mortgage owner or mortgage ready or near ready, then you are not currently mortgage ready. So based on this approach and definition, we basically size the credit visible population below the age of 45 into these 4 mutually exclusive categories. So let's start with mortgage owners. There are around 22 million mortgage owners. If you look at the very first column, which is the overall population, there are 22 million mortgage owners, which is around 21% of the population. We are able to slice and dice this population by various race ethnicity. So while 27% of the non-Hispanic white Americans are mortgage owners, only 11% of Black Americans, 14% of Latino Americans, and 20% of APIs are mortgage owners. So there is a racial gap in mortgage ownership rate. Next, we are looking at the mortgage readiness rate. That's the third row in the chart. So you can see that around 37% of the overall population are mortgage ready. That amounts to around 39 million. Again, by looking at various race ethnicity, you see that there is a racial gap in mortgage ownership potential as mortgage readiness potential. For example, while 37% of the non-Hispanic white Americans are mortgage ready, only 23% of the Black Americans are mortgage ready. So there is a racial gap in future homeownership potential. That said, 3.4 million of Black Americans are mortgage ready. Next, we have the near mortgage ready category. So again, 12.2 million of the overall population are near mortgage ready. Lastly, the last category is the not currently mortgage ready population, and we will talk more about it later in the presentation. But you can see that around 53% of the Black Americans are not currently mortgage ready. One thing I want to point here is that if you look at the Asian Americans and Pacific Islanders, around 59% of them are mortgage ready in aggregate. However, even though APIs are considered as a population, aggregate population overall, we have to acknowledge that there is a lot of variation across the API population. They basically span through a broad spectrum of countries of origin and nationalities through the Asia Pacific. Our unique data capability allows us to basically disaggregate that population by various API subgroups to better understand their homeownership potential. So here we are able to disentangle the mortgage ownership and readiness status of various API subpopulation, and we see that there is the consistency in the story doesn't hold. For example, 64% of the Chinese population are mortgage ready, but only 35% of the Hawaiian population are mortgage ready. So there is a big variation in the mortgage ownership as well as mortgage readiness rate across the API population. In a nutshell, while there is a lot of racial gap in homeownership rate or mortgage ownership rate, there is still a lot of future borrowers and a lot of opportunities for the future across different minority groups.
Thanks, Jaya. It's important to quantify who are mortgage ready near, and not mortgage ready to help better understand our future borrowers. Larice, let's look at those not currently mortgage ready. What opportunities do you see for them? And what actions do you suggest in helping them become mortgage ready?
Thank you, Cindy. Thank you for including me in this panel, this very important conversation today. As I start to look at this not currently mortgage ready and where the opportunities there lie, I want to go back to the conversation that Jaya was just having around the not currently mortgage ready. In her slide, she showed you that nearly 33 million consumers, or 31% of the consumers within that 45 or younger group who do not currently have a mortgage, are in the not currently mortgage ready category based on, again, the credit information that we're able to observe in the anonymized credit bureau data. So we can start by taking a look at the reasons why consumers are in that not currently mortgage ready classification that we've set up here. The vast majority do have delinquencies, including recent late payments on their credit reports, 2/3 in fact. But also note that clean thin file group in the slide. These are consumers with 2 or fewer trade lines, but no severe delinquencies, no severe derogatory information on their credit report. That accounts, in fact, for 1/4 of the not currently mortgage ready population here that we observe. Lenders may have more of an opportunity here if they can evaluate, for instance, bank records of how consumers are paying, and then recent innovations in credit reporting may help with this as well, such as rent and utility reporting. For instance, Freddie Mac's multifamily has formed a partnership with the fintech group Isusu to help solution in this very space by encouraging more robust rent reporting. So there are opportunities here, in addition to potentially counseling and financial education, to help address understanding the thin credit file as well as the derogatory information. We can look at the clean thin file opportunity by race and ethnicity, just as Jaya broke it out for the mortgage ready group. We can do that for the not currently mortgage ready as well, and the clean file group in particular. Here we see that it is as high as 33%. Again, these are consumers who do not have derogatory information in their credit report, their credit file. They're clean, but they have 2 or fewer trade lines. We're talking about as high as 33% for the Asian and Pacific Islander consumers, and 29% for Latino consumers. There's still 22% for within the Black consumer population for the not currently mortgage ready with the clean thin files. And just as Jaya did, I will show the diversity within the Asian and Pacific Islander group, since we have that data as well here for the not currently mortgage ready. Okay. And here again, we also have the variation based on the diversity in the Asian and Pacific Islander community, where our insights allow us to deep dive there. For instance, we can see that 40% of the not currently mortgage ready Chinese consumers in this data set, 40% have clean thin files, and 24% of the not currently mortgage ready Filipino consumers also have clean thin file. So let's think about the implications of this information a little bit. One way to grow your business while helping to move consumers to mortgage ready status is to leverage relationships with realtors and housing counseling agencies, especially HUD approved housing counseling agencies that can offer that robust homebuyer education and counseling service. To understand this benefit, we conducted research using a survey administered by the FHFA, the Federal Housing Finance Agency, and the Consumer Financial Protection Bureau in their National Survey of Mortgage Originations. Here's an example of a key takeaway from that research. So for instance, we find that consumers participating in homebuyer education and counseling may be in a better position to talk to a lender For example, if you look at this chart, let's go to the second row of this chart here. Consumers that report that they participate in education or counseling report that they are more likely to understand various aspects of the mortgage process. But looking at the second row here, 67%, that's how far out these two bars go in general, of respondents say that they are familiar with their credit history or credit score. Yet the blue bar shows that those reporting homebuyer education or counseling were more likely to say they were familiar. Then when we add controls for the likelihood of being in counseling based on differences in credit score, LTV, DTI, and such, we find that we still have this 6 percentage point difference in the likelihood of saying that they're familiar with credit history, their own credit history or score. So the numbers here, if you see a number, that means that it remains to be a difference for the those who report homebuyer education and counseling, even after we take into consideration differences between the two groups who may have participated or may not have participated. Similarly true for the income needed to qualify for a mortgage, the process of taking out a mortgage, the different types of mortgages available, and the available interest rates. Again, to summarize, the not currently mortgage-ready consumers represent an opportunity for lenders to form relationships that may grow their business, especially with these HUD-approved counseling agencies.
Thanks, Larice. These are great insights and opportunities that you were able to share with us. Appreciate it. Next, let's look at the mortgage-ready population. When we look at drilling down by segments, let's look at minorities who are mortgage-ready. Jaya, can you give us examples of how we've looked at minority as well as even income to better understand the challenges and then looking at the opportunities for them?
Sure. Thank you, Cindy. So as we all know, the homeownership rate varies substantially in the US by race ethnicity. There is substantial racial homeownership gap or minority white homeownership gap across all income spectrums. We do some deep dive trying to understand these racial homeownership gap by various income buckets. So here I'm reporting the racial homeownership gap for the middle income bucket. So the way we define middle income is if you are between 80 to 140% AMI, if your household income is between 80% AMI, area median income, to 140% area median income, then you are a middle income household. So within the middle income category, this chart here reports the homeownership rate by different race ethnicity. So you can see that there is racial gap in the middle income homeownership rate as well. So for example, for Black Americans, the racial gap is around 19.1%. For Latino Americans, it's around 18.8%. And for AAPI population overall, it's around 17.9%. So there is a substantial gap. Next, we try to understand for this middle income group, which has higher income, what about their credit constraints? So we try to look into, in terms of opportunity, their mortgage, like how many could potentially qualify as a future borrower. So here we report the count and the share of the population within these race ethnicity that are middle income for each mortgage ready as well as near ready. So for example, remember in the beginning, I had pointed that around 3.4 million Black Americans overall are mortgage ready. For the middle income bucket, that number is around 380,000. Another 90,000 Black Americans are near mortgage ready. So if you add that up, around 470,000 Black Americans could potentially qualify as a future borrower or serve as future borrowers. That number for Latino Americans is around 1.4 million, and for AAPIs, around 670,000. So there is a ton of opportunity within the middle income buckets, or lots of mortgage ready and near ready population within the middle income bucket for minorities. Overall, approximately 2.54 million middle income minorities could potentially qualify for a mortgage. So what are some of the barriers to homeownership for the middle income bucket. One of the big barriers that we look into is affordability. Affordability is a big constraint right now with the current environment of rising interest rates and house prices. So we basically came up with a measure of affordability where we are computing the maximum housing budget of the mortgage ready middle income consumer. So the maximum housing budget or the mortgage capacity measures the maximum house price of the mortgage ready renter that the mortgage ready renter can afford, given that his income and debt obligations are met under the current mortgage rate for 30-year mortgage and a 3% down payment. So what we do is, it's a very simple idea. We subtracted the non-housing expenditure from the income of the mortgage ready consumer to see how much money is available for a monthly mortgage payment on a house under certain assumption that their hypothetical back end debt to income cannot exceed a certain threshold. Then from the monthly mortgage payment, we back out the highest house price they can afford under the assumption of the current mortgage rate. It's a 30-year contract and they are putting 3% down. Then we track this affordability, the maximum housing budget on a monthly basis. And that's the line that you see on the top. So the four lines on the top gives you the maximum housing budget for each race ethnicity. So you can see that it has been decreasing a lot since last 1 year because of the rising interest rate. We compared this maximum housing budget with the fair market value of the median price single family home, which is given as the green line. It's at the national level. So basically it's a national aggregate. And you can see that for that middle income bucket, the gap is still positive, which means that most middle income mortgage ready consumers can have the credit and the income to afford a house as well as their current non-housing expenditures. So what would be their biggest barrier in that case if they have the credit and the income? Well, as you might have guessed it right, this is it's down payment. So down payment currently is the biggest challenge for the consumers who have the credit and the income to afford a house. So we did some deep dive trying to understand or quantify how much down payment or how much cash is needed at closing for the consumers who are mortgage ready and who have the income to afford the house. So here, the very first column here gives you the gross 3% down payment based on the area that the mortgage ready middle income consumer is living. The second column gives you the estimated closing cost, again based on the median priced house in the area that they're living. And then the third column gives the 6-month savings. Let's assume that they are saving for 6 months, and that's the 6-month saving. So basically, the estimated cash to close would be the first two columns. We add the first two columns and then subtract the last column. And that is given in the very last column. So you can see that the estimated cash to close can range from 10,000 to all the way more than 16,000 by different race ethnicity. So even though they might come up with a 1-year saving, that is not enough to cover the estimated cash to close. So more focus is needed by industry to on this barrier to reduce the homeownership gap. Lastly, we try to do some more deep dive in trying to understand what are some of the sources of funding that current or recent homeowners are relying on for their down payment. So we use National Survey of Mortgage Originations for this to basically address this question. The survey asks the question to recent borrowers: did you use any of the following sources of funds to purchase your property? And some of the sources of down payment they included in the survey are from sale of another property, savings and other assets, assistance from government or nonprofit, gift from family and friend, seller contribution. The very first column gives the response rate for the white borrowers. As you can see, most borrowers rely on savings and other assets as source of down payment funds. The response rates we also were able to basically disentangle the response rate by race ethnicity, and we had response rates for Black consumer borrowers as well as for Hispanic borrowers, and they were higher or lower depending on the question. However, one could argue that some of these changes in response rate is because of the racial difference in credit quality, racial difference in income, or racial difference in other borrower or loan characteristics. To account for that, we basically computed the estimated difference in the response rate after controlling for these credit quality, borrower characteristics, and loan characteristics. And we report the estimated difference between Black and white consumers' response rate and the Hispanic and white borrowers' response rate in the second and the third column, respectively. If it is marked in blue, that means they significantly rely more on this particular source of fund. If it is marked as red, that means they significantly rely less on this source of fund for down payment. So as you can see, Black first-time home buyers are more likely to rely on assistance from government and nonprofit, and less likely to rely on proceeds from sale of another property to meet their down payment requirements. Latino first-time home buyers are less likely to rely on gifts and grants and seller contribution to meet their down payment requirements.
Thanks, Jaya. These are great examples and really actionable solutions to better source more loans for the borrower of the future. One barrier I hear a lot about is student debt. I know there's been a lot of research on this, and we have done some ourselves. Clarice, can you share some of the insights that we've been seeing?
Absolutely, Cindy. Thank you for that question. Interestingly, Jaya and I have done, a lot of other research where we were looking at like the impact of student loan debt on things like, the probability of becoming a homeowner through a mortgage acquisition, for instance. And we got a lot of feedback that we needed to take a step back and look at this broken out by race and ethnicity, for instance. And so, yeah, we've been doing that work. Continuing with the anonymized credit bureau data, we can look at the prevalence of student loan debt, again, as another potential headwind for minority consumers looking to purchase a home. In this chart, we are again looking at the anonymized credit bureau, the anonymized credit bureau data. Let me go to this one here. And what is the prevalence of student loan debt for various consumers? One thing we see is that for Black consumers, we see that it were 5 percentage points more likely to have a student loan debt compared to white consumers, that being at 14% for Black consumers. And that's the highest for the groups that we're looking at in particular here. When I take a look at the dollar amount of that student loan debt, in fact, we see that Black consumers with student loans also have the largest student loan debt burden, with a median of more than $20,300 for the typical student loan debt when it exists. Again, for non-Hispanic white consumers, that's about $16,700 or $800, and for Latino consumers, considerably lower at under $14,000, closer to $13,000 for Latino consumers. So big differences by race and ethnicity for the prevalence of student loan debt, as well as the magnitude of the student loan debt. Because we see that being a larger debt burden for Black consumers, we decided to take a look at the geographic distribution. I need to give a shout out to Jaya's team for these maps, these wonderful maps. Here we have a map showing the student loan debt by metropolitan area. The larger the circle on the map, the larger the number of consumers with a student loan debt. In particular here, we're talking about the student loan debt for Black consumers in particular. And as the color goes from green to red, the median student loan debt for Black consumers is increasing. One interesting observation I see as I look at this is that it's pretty widespread in areas where, in many of these metro areas along the coast, But I also noticed that the student loan debt is not just relevant for higher price areas. For instance, if I look at a place like Atlanta, there in kind of the north center of Georgia, we can see that even for what might be a more moderately priced metro area, we also see the red, very large student loan debt burden there as well. Okay. Some additional research that we worked on here, in collaboration with Jaya's team in particular, again, was thinking about the impact of this student loan debt and the debt to income ratio. I believe with recent policy discussions and decisions related to student loan debt, it makes it very worthwhile to consider how changes to the debt to income ratio might affect the purchasing power of mortgage ready Black Americans in particular. If you look at mortgage ready Black consumers' potential purchasing power, say that what Black Americans may be able to purchase by obtaining a 30-year fixed rate mortgage with 3% down. And the numbers that we are using here are going to be kind of pre-COVID pandemic numbers to illustrate the point of for this analysis. So if we do that, if we look at that in a situation, the orange bar tells me that with the observable student loan debt included, the typical Black mortgage ready consumer could afford a $387,000 home. However, if we recalculate the debt to income ratio by removing the student loan debt, the purchasing power increases to $438,000, an increase of $51,000. So very significant implications for the ability to afford across various geographies even. So there's a lot there with student loan, a lot of conversation. We'll have to see how everything pans out from the policy discussion there. Thank you, Cindy.
Thanks, Larice. That's really powerful research and information that you gave us. I often get asked about what resources are available to better understand affordability challenges. Jaya, I know you are excited about the new tool your team has created to provide to the industry. Can you share it with us?
Sure. I'm very excited to share this tool that we just rolled out recently. It's a great tool that basically provides you with an opportunity. It's a self-service dashboard, which gives you an opportunity to size or look at the future borrowers or the whole economics of the future borrowers by various metrics. So this is how the tool looks like on our website. It's published on our website along with a white paper that explains the methodology behind some of these definitions that have been referred to in the tool. In the tool, you will see a map. The map will have bubbles. Basically, the size of the bubble denotes the count of the mortgage-ready population, and the color of the bubble gives the measure of our affordability. We call it the first-time homebuyer affordability map. Basically, it's telling you what share of the mortgage ready in a given geography can afford a home that was recently sold to a first-time home buyer in that geography. So the darker, the more green the color is, the more affordable that geography is. The more red the color is, the less affordable the geography is relatively. So, and you have bunch of selections that you can do. So you can select the year. If you want to look at time trend, we have the data all the way from 2012 to 2020, and we are updating the information so we can get more recent data. You can select by income group if you want to look at the overall population, overall affordability, or break it down by low income, low to moderate income population, which is between 0 to 80% AMI, or middle income population, similar to the example that I gave you, between 80 to 140% AMI. And then you can also break it out by various race ethnicity. And for once you make the selection, the map will change and the values are going to change. Another interesting feature in this map is that once you hover on any of this circle or any of these MSAs, you will find all the local information in the table right below. So that MSA, you will have the account of mortgage ready for that MSA, the value of the first time homebuyer affordability map, which is the affordability measure for that MSA, the housing stock ratio, which basically is inventory divided by sale, a measure of gauging the housing supply in that MSA. The higher is the ratio, the more adequate housing that MSA has. And the rule of thumb is if it is more than 6, then it has enough housing stock. Otherwise, it doesn't. And then the last one is median year to save. How long does it take to save for 3% down payment in number of years? So all that information is basically provided at the MSA level. You can basically, this is an example on how the tool can be utilized to understand the future borrowers and the trends by various subpopulation. So on the left-hand side, but if you select on the overall population, this gives you the bubble here, the size of the bubble gives you the count of the overall mortgage ready population by different MSAs, and the color gives you the affordability of that overall affordability of for the overall population in those MSAs. On the right hand side, this is what you see when you select LMI. Keeping everything else same, but just selecting for low income population, the bubble changes. Now the size of the bubble gives you the LMI count, the count of the LMI mortgage ready in each of these MSAs, and the color of the bubble gives you whether or not these MSAs are affordable to its own LMI population. And you can see that there are big variations. For example, a lot of the cities that are affordable to overall population may not be affordable to its own LMI community. For example, the cities in the south, particularly, you see that they are greens in the left-hand side map, but they are now red on the right-hand side map. They do not fare any better than some of these unaffordable coastal cities when it comes to LMI community. And lastly, this is where you can find the link to the white paper as well as the tool. And we are hoping that you can use this tool and to better understand the future borrowers.
Jaya, that is fabulous. I know I'm so excited about the tool. I know I get so much good feedback. Thank you. This is an amazing way to drill down and really better understand affordability geographically. So thank you. So as you can see, we are providing data-driven decisions to help provide actionable solutions that are intentional and deliberate. So as a summary, let's look at some of the highlights that we've talked about today. The 39.2 million mortgage-ready population could become borrowers of the future. This is a huge opportunity. The 25%, which is 8.2 million, of the not currently mortgage ready that have clean credit, but with a thin file, could move to near and mortgage ready status with counseling and financial education. Of the 3.4 million mortgage ready Black Americans, 380,000 are middle income, who have enough income to support their debt and a mortgage payment and could help to reduce the homeownership gap. Down payment is a barrier to the mortgage-ready segment. Reducing cost at closing low down payment mortgage solutions or assistance could increase opportunities for minorities. The Freddie Mac First-Time Homebuyer Affordability Map allows the industry to measure opportunities and identify solutions to bridge minority homeownership. Let's talk about next steps. We hope you take these insights and make them actionable that we talked about today. I want to challenge you to ponder how you will use them in planning, prioritization, and in your outreach. How will you use the tools to help mortgage-ready individuals prepare and become future borrowers to make home possible? With that, I think there is time for a few questions. Let me look at what I'm seeing from the audience. Larice, it looks like I'm seeing one here that might be good for you to respond to. Based on challenging economic and affordability landscape, are there trends or forecasts that predict that minority homeownership gaps will continue to increase, or are certain groups more impacted than others?
Thank you. Wow. Always a challenging question. The racial homeownership, gaps remain significant. Definitely require us to continue working to counter the trends. Some people were thinking that we were actually seeing some improvements recently during the pandemic. We're watching that closely as we're trying to figure out if that was, kind of the survey data during the pandemic, or are those trends going to remain favorable? The pandemic has definitely made it more challenging to figure out. We're starting to see positive economic growth. I was listening to the chief economist, the Freddie Mac chief economist recently talk about positive economic growth. The labor market is strong. That certainly helps because, for instance, Black consumers tend to be disproportionately affected by unemployment spikes. But inflation continues. House prices, while they've cooled down, inventory has been increasing, but these house prices in a lot of markets certainly still remain a challenge. Jaya showed some trend lines with the affordability numbers. They were extremely challenging into this year for all groups to purchase a home, where the house price, was really starting to grow up and cross over, what the typical households in the middle income, especially the lower to moderate income consumer, could actually afford. On the positive side, potential student loan relief could be there in student loan debt, helping to close the middle income minority gap. The GSEs have adopted, the equity. We have certainly embraced our equitable finance housing plan to really put deep thought into how to move the needle in this space. Feel free to go and check that out. And for you, for those of you who are listening and thinking about what you can do, again, I want to encourage you to think about leveraging diverse relationships for down payment, assistance, low down payment options that are available in the conventional and GSE space would be worth looking into. I'll pause
Great.
there in case there was other questions or thoughts. Thank you.
Thanks. That was a great response. Jaya, there is a lot of questions about your tool. So let me pick up on some of them. So first of all is, are there plans to, like, when are you going to update it? Like, what is the cadence? Is there any plans to add any criteria to it? And then I think we also had people don't believe the cost of it. So again, reassure them, again, it's free, right? So can you respond to some of these questions I've been asking?
Sure. Yes, absolutely. We would love for people to use the tool and more frequently. So we are definitely planning to update it, and hopefully we will be updating it by the end of the year. We are on track. There is, we may add some more stats around like various API subpopulation, like the subgroups, more stats on the housing stock. But yeah, and we are hoping that we should be able to update it either twice a year, or if we are successful in updating quarterly, then it will be even more frequent. So yeah, I mean, definitely we are very excited about the tool and hoping that the industry will be benefiting from this tool, and we'll make it more real time.
Great. And again, you can find this on freddiemac.com/research. And Jaya presented that. We are out of time, unfortunately, but I want to thank you for joining us today. We hope you found this information useful and actionable. I'll pass it back to Kira for a final session wrap up. Thank you, everyone.
Thank you so much, Cindy, and thank you to all our presenters today. If we did not get to your question, we will connect with you following the conference. Please remember that your opinion is important to us, so please take a few moments to take our brief survey so that we can continue to bring you timely and relevant content. You can also log in anytime after the conference to play back any session presented today. Thank you and enjoy the rest of your conference.
Hi, everyone. I'm Tim Kitt, Single Family's Head of Pricing and Execution. We want to thank you all for attending the 7th Annual Connect Conference. It was so great to see so many of our industry partners again in this virtual platform. As we stated at the start, we hope you're leaving with new ideas, new skills, and a whole lot of momentum to advance the work that you're all doing to make this industry even stronger. Thank you for joining us and for making the event a success. We shared with you the insight into the regulatory environment from our fireside chat with FHFA's Director, Sandra Thompson, and our own CEO, Michael DeVito. We're all very excited by her enthusiasm and her commitment to expand our mission to make home possible. A huge thank you to our sponsor partners, both our title and premier sponsors. This event would absolutely not be possible without your support. Our theme this year is The Power of Two, helping you to successfully grow and manage your business. Our goal was to provide you with better insights that will lead to better business outcomes, and we really hope that we've succeeded in this regard. Please help us make next year's Connect conference even better by completing the post-event survey, and we all look forward to seeing you again next year. Thanks so much.